Okay, Tanya, you asked for it. You said you wanted an explanation of those tax things. Let's take a look at it first. The first one, and I can't really put this one on a spreadsheet, but when we look at the annual report 2018-2017, remember the big item, and we saw that just in the financials from the FINRA or Morningstar, wherever, but the effective tax rate, look at that one, from 13.2 up to 55.3. They paid a whole bunch more in taxes, right? And it reads here, and you probably read this because you'd put that in your email. So the impact of the Tax Act primarily reflects provisional expense of $1,875,000,000 for the one-time transition tax on the deemed repatriation of undistributed foreign earnings. Okay, and all that means is, and I tried to explain that in the email, but U.S. companies, when they make money overseas, Nike sells a lot of stuff here in the United States and makes a lot of profit, and they pay their taxes on that. When they make money overseas, they're not required to pay taxes on that until they bring that profit back to the United States, or repatriate it is what they call that. Okay, so Nike makes a lot of money in Europe and China and Japan and who knows where. Okay, and that money then, rather than pay those taxes in the past, they've left that money overseas, right? They don't bring it back. They don't invest it in the United States. They don't do anything with it in the U.S. They may be investing it in other places, but for the most part, a lot of companies have just sat on that money, okay, overseas, and didn't want to bring it back because they would have to pay the 35% tax. They already paid tax in the country where they earned it. So if Nike made $1 billion in Japan, they would have paid the Japanese tax. Okay? And if they'd brought that profit home, after-tax profit home, they would have had to pay another 35% here in the United States. The tax law changed that and said that companies can repatriate or bring money back to the United States, and instead of paying 35%, they would pay 5.25%. So a huge difference, and a lot of companies wanted to take advantage of that. You never know when the tax laws might change again. And so in this case, and I did the math a little bit, but that means that at $1.875 million or $1,875,000,000, Nike brought home about 30. I did the math, and now I can't remember what my answer was. I think it was about $34.7 billion. I'll do it again. 1,875,000,000 divided by 0.0525. $35.7 billion that they had stashed overseas, and they didn't want to bring it home and pay 35% on that. That would have been a $10 billion tax bill. Instead, they were able to bring it home and pay a 1.875. A big number, but much less than it would have been. And this allows them to bring it home, hopefully reinvest it, etc. Okay. The second part is the part that, and it was a relatively small part, I guess you could say relatively small, $158 million, resulting from the remeasurement of deferred assets and liabilities. And I'll show you a little spreadsheet on that. But we found this out. I saw this with some of the students in class, and they were doing more. A couple of them did automotive or machinery companies, like John Deere, I think, was one, or Caterpillar was a big one. But then automotive companies as well, and we saw some really big numbers for this same thing. And boy, I hadn't seen that before, and the reason was because it had to do with the Tax Act, and I really had to go and do a bunch of reading to try to figure out what it meant or what was causing it. And I'll show you here now with the spreadsheet. So it's important to note that companies, corporations that are listed, that are public companies that you and I can buy stock in, really have two types of accounting that they have to do. The one type is accounting, I'm going to call it for SEC. It's called GAAP accounting, generally accepted accounting principles, but that's what they have to report to shareholders and prospective shareholders. Okay. The other is they have to report for the IRS for the payment of their taxes, right? They're kind of two separate things, at least when it gets to some stuff. Some stuff's all, as you go down the income statement, it's going to be the same. Okay, some is going to change. Okay, and I've got balance sheet down here, and the IRS, doesn't really give two hoots about the balance sheet, because they only charge income tax, right? And so they're only concerned with the income statement, which we see up above. So here's a comparison. So, if we're doing our taxes, they have sales. Well, they report the same amount, right? Cost of goods sold, we report the same amount. So we got a gross profit, that's the same amount. We've got operating expenses, which can be payroll, heat, utilities, those types of things. Okay, and I've just made up amounts here. Okay, but then I've also got an estimate of returns, recalls, etc. This is what we really saw with the big machinery, automotive companies, and those types of things. And what that is that, okay, in the year that they make and sell a car, they know that there's a chance, and they can figure this out by a percentage, that they're going to have so many returns and recalls and things like that they're going to have to fix or repair, and it's going to cost them some money in the future. Okay, the SEC, or what they report to the shareholders, requires that they show that. So in my case, I'm saying that it's 10% of sales. I think for the automotive and the machinery companies, it was closer to 4 or 5%, but I just used a 10% number, right? So 10% of sales, we might have returns or recalls or those types of things. What it is for Nike, I'm not sure, because being a shoe company, I don't think they have a lot of recalls. They might obviously have some returns and some things like that. But anyhow, it's a set percentage, okay? And so that they kind of know, they know through experience for the past 20 years as to about what that percentage is. And so in this case, for the shareholders and prospective shareholders, they have to show that, and they show that up front in the year that they had the sale. Okay, but the IRS doesn't give two hoots about that. The IRS is concerned about when that return or recall actually happens, which is going to be at some point in the future. Okay, it didn't happen this year. Okay, so we put this down then as an estimate of returns and recalls, etc. Okay, and this is what we show to our investors then, is that kind of based on that, we only made $300,000 as opposed to $400,000. Okay, but what happens? Well, eventually, when this $100,000 of returns and recalls happens here in the future, we will get to deduct that from our taxes for the IRS. Okay, so the full $100,000, yeah, we got to report that, but on the other hand, we're going to get some of that back in the future, and so what they do is they set up a tax asset account, they call it. Okay. And with the old tax rate for corporations was 35%. So that meant that when they deducted this, okay, in this year, okay, they would get a $100,000 deduction, and that would benefit them to the tune of $35,000 in the bottom line. I didn't put after taxes here, and I probably should have, but it would benefit them $35,000 in terms of less taxes that they would have to pay in the future. Okay, so that becomes an asset then on our balance sheet. Again, the IRS doesn't care about the balance sheet, but on our balance sheet that we show to our shareholders. Okay, so because the tax rate was 35%, that asset was $35,000. The tax rate changed to 21%. All of a sudden, this $100,000 that we're going to write off in the future, that we've created a tax asset for, isn't worth $35,000. It's only worth $21,000, because the write-off's only going to be at 21% in the future. And so we have to make an adjustment then, okay, to our balance sheet basically, and that also shows up then on our report to the shareholders and whatnot. Okay, that we make an adjustment. The adjustment would occur up here in the profit and loss, right? that we've made an adjustment for that tax asset of $14,000. Nike's was $158 million. So, you know, we could kind of do some math on that maybe and figure out what their, you know, what their tax asset account was. I'm not sure how important that is. Okay. Kind of a complicated deal. I hope this helps to clear it up a little bit for you. And again, I'm not sure what Nike's, and I didn't read their annual report enough to see, but what their actual tax assets are made of. It says deferred. What did they call it? Deferred assets, which were a net benefit. Let's see. Yeah, $158 million resulting from the remeasurement of deferred tax assets and liabilities, and on the liability side, I'm not sure what that would be either. So it gets to be a lot confusing. Okay, did for me, and had to do a lot of reading this last fall to kind of figure that out. So hope that helps, and hope this helps.